Well, Andrew, whether it will continue to be so, I think, is the big question. You've talked of policy primacy in this outlook. Is that still the number one issue, the policy outlook?
I think so. And, we should always be humble, but, really humble at the moment dealing with these kinds of events. In terms of the outlook, we've had this big drop. We are seeing improvements. We should have something which feels like quite a strong recovery in the near term, but still that gradual climb to get back to where we were at the start of the year. I think that while we need to watch very carefully the health statistics, the patterns in the U.S. states. You do have a lot of policy support in place. I think that's going to continue to be anchoring in terms of financial markets. We think that there's a real bias to do more on the part of monetary and fiscal policymakers. In terms of how to invest, we don't think this is a time to go out and chase assets where they have already recovered very significantly. But there are lots of good opportunities to buy high quality assets at pretty attractive valuation or with pretty attractive return profiles, and things like U.S. agency mortgages or high quality credit, corporate credit, senior financials, that kind of safer part of the spectrum. I mean, I think there's lots of interesting things we can do there.
Andrew, I want to come off of John Farrell's important interview yesterday with Bob Prince of Bridgewater, which is we're now at the zero bound, and certainly the timeline has been extended out to a dampening of the economy, a lassitude to the economy. We're all assuming yield curve control. What if we go the other way and begin to see a real disinflationary tendency where the yield curve control is about too low of rates? What's the likelihood of that happening?
So I think we have stumbling on my words. We have yield curve control de facto already in a number of places. It seems like there's a pretty high chance that you'll see this formally on the part of the Federal Reserve before too long, but looking to anchor the front end of the curve, not the 10-year part of the curve like in Japan, but the 2 to 3 year part of the curve. So that real commitment, it's going to be a long time before they raise policy rates.
Well, we talked to your Anthony Crescenzi the other day, and Andrew, this is a critical question as well. What is the efficacy of yield curve control if they can only go out 36 months?
So I think a couple of things. I think that there's only so much that yield curve control can do when you have such low levels of yields and with the shape of the curve that we already have. So I don't think it's that exciting a prospect. In a world where we get better macro news, good news on the macro front, then it could be important because the Federal Reserve would with the yield curve control, would be able to lean against any premature tightening on the part of fixed income markets if that's what they saw. But I would agree with you. I think there's only so much that monetary policy, QE, yield curve control can do. I think the handover to the fiscal side is the important thing. On negative rates, I think it's unlikely that this will happen in the U.S. When you look at the costs and the benefits, it's hard to see a great case for negative policy rates. But I think it's helpful for central banks to at least give the impression that they might do that, because again, that is anchoring. Even if you think there's only a 1 in 10 chance or something, that's anchoring in terms of fixed income markets. So, in the event of a very bad macro outcome, it's possible that we could see negative policy rates in the US or the UK. But in the baseline, I think it's very unlikely.
Andrew, given how low yields are, and given the fact that U.S. pensions are still looking for 7 to 8% annualized returns, what's the appropriate annual return target that you see, given where we are?
Well, I think that's a very good point. I think that often return targets are too high. We have certainly taken ours down, and what we use in our internal models and our internal guidance. But I think 4 or 5% type levels are more realistic looking at over the next years. At least, a lot of plans have come down from the double-digit type returns that they once upon a time had, but 7 to 8% still looks pretty high in terms of starting valuations. And the way we are managing our portfolios at a time when you have some good opportunities, but certainly not cheapness across the board. It's better not to try and push too hard to achieve unrealistic return targets. It's better to be realistic that with a reasonable balance of risk, it needs to be lower in terms of the expectations.
Andrew, I've got 60 seconds on the clock. Forgive me for keeping this one tight, but people think we're vulnerable for another shock here. And I'm trying to work out what the defensive asset of choice should actually be in that environment, with rates already zero and Treasury yields already very low. Where do you go?
So I think the U.S. interest rates, I run global portfolios, and from a global point of view in particular, I still think that U.S. rates remain the U.S. interest rate markets remain the most attractive. If you do have a shock, even without a shift on the part of the Fed to negative rates, there's further for U.S. rates to fall. Whereas when you look at other markets, you're going to need more of a shift in the central bank regime to allow that to happen. So I think duration is one important point. You can look at using currencies as another way to look to have some defense against adverse shocks. But I think at our investment committee, while we look at all different ways to do this, you have to be realistic, and with less of a hedge from interest rates, you need to think carefully about the level of risks you have in your overall portfolio. You need to reduce risk if you don't have the same efficacy of the duration position in your asset allocation.